The investors are awaiting a number of key retail earnings next week. Joining us now, Stephanie Link, Chief Investment Strategist at Hightower and a CNBC contributor. And normally I kind of I use some of these headline pieces to in a contrarian way. But today on MarketWatch, I saw one this morning, and I read through it. It's pretty well written, actually, Steph. And that is that this has been a huge head fake for the bulls, what we've seen in the last 6 weeks, and that now the smart money is definitely on further downside, and they go into some, put call ratios declining, breadth declining, new highs and new lows. What was helping there now looks like that's breaking down. The SPX below key support indicating lower levels. Are we now, is it a confirmed head fake that we're definitely headed to test the lows, do you think, on the S&P?
Well, look, I mean, I think this is a trading range, choppy kind of a year, right? We've had a nice start to the year. So could we see a pullback? Certainly. But what I'm encouraged about, what you just said, there are so many bears out there. So many people are negative, especially on the economy, especially on earnings. And I don't see it, Joe. I mean, look, I get that the Fed, what they're doing is going to slow the economy. Don't know if it's going to head us towards recession or just a slowdown. Okay, so we get that. But the economy has actually been really resilient. I mean, GDP, 2.7% yesterday, right? And the first quarter Atlanta Fed GDP now number is trending to 2.5% for the first quarter, right? You have initial claims below 200,000. You have even the Chicago Fed, the National Activity Index. It's an important index to watch. And it just turned positive for the first time in 4 months. And then, of course, you had earlier this week the ISM services and the composite numbers at 50 in expansion mode. I'm not saying we're off to the races. I'm just saying the economy is actually in better shape. There's more underlying momentum than it's getting credit for. And as a result, I think earnings can hang in there. If you exclude technology, Joe, earnings are actually up 6.5%. If you include technology, earnings are down 2%. So I don't want to, just kind of exclude a group and say everything is great. But I'm just saying underneath the surface, things are not as bad. And I think that we can kind of be in this trading range as a result until we get more clarity in terms of what the Fed is going to do and what that means for the underlying growth.
6%, or whatever you said, 6.5% is eerily similar to the inflation rate right now. Can't you just raise prices and can't it just happen from that almost if they stick? Is it real?
Well, I mean, look, I think companies are doing a really good job at certainly restructuring, doing a lot of cost cutting, and raising prices.
And raising prices, if they can.
And raising prices.
So it's not always bad for companies.
But they're adapting.